Interest rates are rising. What does this mean? Well, it costs a little bit more to borrow money, right? So the central banks do this, or they raise interest rates to fight inflation, which unfortunately is what we are experiencing right now, right? Things are more expensive. So increasing interest rates essentially cools down the economy a little bit because it costs more to borrow. So people and businesses borrow less, which means they spend less, which eventually brings inflation down. So the $1 million question is, which sector, what companies benefit from rising interest rates? Well, the answer is pretty simple. It would be financial companies, right? Like banks and insurance companies. So let's quickly look at why financial companies benefit from rising interest rates, and then I'll show you what I think are the best two ETFs in Canada that you could invest in, which hold the best financial stocks in Canada, and where you will get maximum total return on your investment. And a little later, we will talk to a financials expert, Rob Wessel from Hamilton ETFs, and get his take on why rising interest rates is a good thing for financial companies and financial stocks. I can't think of anyone better to ask and talk to about this, since Hamilton ETFs really specializes in the financial sector. And luckily for us, Rob is a very good friend of the channel and made himself available to us once again to answer some questions. So let's get to it. So usually when I want to check out something or do some research, I always go on Investopedia for some explanation. So I found this great article. I'll put the link in the video description. These sectors benefit from rising interest rates. And right off the bat here, you could see in the key takeaways, financials benefit from higher rates through increased profit margin. So if we scroll down, they even have a little video here. But if we scroll down and we look at financials first, we look at this section. It says the financial sector has historically been among the most sensitive to changes in interest rates, with profit margins that actually expand, so they get bigger as rates climbs. Entities like banks, insurance company, brokerage firms, and money managers generally benefit from higher interest rates. So when it comes to banks, rising rates tend to point to a strong economy, and that usually means borrowers have an easier time making loan payments and banks have fewer non-performing assets. It also means, I think this is the key point here, that banks can earn more from the spread between what they pay to savers from savings account and certificates of deposits. In Canada, we call that GICs, and what they can earn from highly rated debt treasuries. So banks make more money because they typically keep their money in very safe, highly rated debt securities like treasury. So when you go to the bank, get a GIC, or in the US, it's called the CD, certificate of deposit. Don't think that they're just taking your money and putting it in a vault somewhere. They actually invest that money while they're holding it for you, and they're making the profit off of your money. They usually invested in things like high yield government bonds, which are very safe. So whatever they get, whatever the difference is between what the interest is on what they give you and what they're making, that is pure profit. And on a side note, this is why I always tell people, do not get GICs or CDs. So banks that might benefit include, of course, you have all the big banks here, brokers as well, brokerage firms also benefit, but also you also have insurance companies. This is what I wanted to look at also. Insurance stocks can flourish as rates rise. In fact, the relationship between interest rates and insurance companies is linear, meaning the higher the rate, the greater the growth. So issuers, which have steady cash flows, are compelled to hold lots of safe debt to back the insurance policies they write, kind of like the banks, right? Like the GICs, like we talked about. In addition, the economic health dividend also applies to insurers, improving consumer sentiment. That means, there's more people buying homes and cars, which means more policy writing. More people need insurance. So there you have it, guys. The article goes on to say that also your consumer stocks do well as also during rising interest rates, and that's pretty much because it's we're looking at a strong economy or a hot economy. So financials definitely benefit. So now the $1 million question is, which are the best ETFs in Canada to take advantage of this? Let's check them out. So in my opinion, everyone, the ETF, which I think is probably the best one or your best bet, is the Hamilton Enhanced Canadian Bank ETFs. This ETF holds the 6 big Canadian banks, except it has 2 twists on it, basically. So As you can see here, what it says, it's the top performing Canadian bank ETF. And I know I've covered this ETF several times on the channel, but basically why this ETF is special is because it does hold the 6 big banks, but it uses a mean reversion strategy, which means that the 3 banks that are recently not doing as well as the other 3 are going to make up the biggest portion of the portfolio, while the 3 banks that are doing better than the other 3 will make up the least amount in the portfolio. So basically they're trying to get the maximum growth possible. And on top of this strategy, which is called the mean reversion strategy, they use 25% leverage, so a loan facility or borrowed money, to increase the returns, right? If you're holding something long-term, great quality, I'd rather own it with leverage because you're just going to enhance your returns and your yield over time, especially now because money is cheap. Yes, interest rates are rising, but institutional leverage is still very, very cheap. So as you could see, this ETF gives you a solid yield of 6.14%, which is much higher than if you would own the 6 banks individually or compared to another ETF, which there are many, many, many Canadian bank ETFs in Canada, right? The 6 Canadian banks, very, very popular. They always outperform the overall Canadian market. So obviously there's going to be a lot of ETF providers out there that are going to provide you an ETF that has the big 6 Canadian banks. But this one here, HCAL, is actually the top performing one. You could see that if you look at the 1-year performance here, this is, of course, total compound return, right? Income and growth. It's 15.78%. If we compare that to another very popular ETF in Canada called ZEB, the BMO Equal Weight Banks Index ETF, which is just the most simplest ETF you could think of when it comes to the big 6 banks. It literally holds the big 6 banks on an equal weighted basis. So you see here that the percentages are basically all the same and there is no leverage on this fund. So if you click on performance and look at the 1-year performance, you will see that it's 12.91%. So it is lower than HCAL. If you look at a covered call Canadian banks ETF, also from BMO, ZWB, if you look at the 1-year performance, it's actually lower. It's 8.6%. So that's completely normal, right? Covered call strategies, as we know, will typically underperform another ETF that does not have, or a similar ETF that has the same holdings but does not use a cover call strategy. Cover call strategies underperform during bull markets, and the last year was a bull market. They only outperform during a flat or a down market. Another popular one is RBNK, very popular ETF here, and even with a lower management fee than HCAL is 0.65, I believe, and this one is 0.33. If we look at the performance in the last year, it's 13.5. So the evidence is clear, guys. If you want maximum total return on the big 6 Canadian banks, HCAL is your number 1 choice. It beats owning the banks individually. It beats owning them on an equal weighted basis without leverage. It beats the covered call one, ZWB, and it also beats this one here, RBNK, which is a little bit unique, a little bit different. It basically tries to allocate the biggest percentage to the higher yielding banks, basically. So let me just click on portfolio analysis here. Where's the holdings? I can't find it here. Maybe I could find it in ETF facts. Let's see here. Yeah, here it is. Perfect. So it kind of looks like it's a mean reversion, or it looks like HCAL a little bit, but basically they're going to put the biggest percentage of the portfolio in the banks that have the higher dividend rates, right? So I think this is also a good idea. As you can see, it's outperforming the equal weighted, but it still does not beat HCAL. So HCAL is definitely your number 1 choice, but this is just the 6 banks. What if you want the life insurance companies, the asset managers as well? Well, Hamilton ETFs just came out with a brand new ETF called HFIN here, which is the Hamilton Enhanced Canadian Financials ETF. So if you look at what it has, it basically has the 6 banks as well, but also the top 4 insurance companies in Canada, which is Manulife, Great-West Life, Intact, and Sun Life, of course. And it also has some asset managers like Brookfield Asset Management, Power Corporation of Canada. So this is a little bit more diverse in terms of financials. So you have the banks, the insurance companies, and the asset managers. And just like HCAL, it has 25% leverage. You know, that's where you could see it here, modest 25% leverage. So My assumption is that it would probably outperform a regular ETF that only holds, diversified Canadian financials without the leverage. So very much like HCAL, except a little bit more diversification. You got the life insurance company. So for me, if you want maximum total return, guys, not necessarily income, I'm talking about not necessarily maximum income, because there are other higher yielding income options out there. But in this video, I really want to focus on maximum total return on your investment. I think the evidence is clear. HCAL definitely wins for just the 6 banks. And I'm assuming HFIN, or I'm pretty confident that with that 25% leverage, it's going to outperform a similar ETF that does not have leverage. So now it's time to talk to a co-founder of Hamilton ETFs, a financial expert, Rob Wessel. So Rob, thanks again for joining us on the channel. You're a good friend of the channel, so I really appreciate you joining us here today to try to explain to everyday normal people the impacts of rising interest rates and how financials benefit. So before we start our conversation, I will direct the listeners and audience to the Hamilton ETFs disclaimer, which is on hamiltonetfs.com/legal. All right, so the first question I have, Rob, is, as we know, the main topic dominating the investing world right now and the world in general is rising interest rates. But before I ask you about that, I just want to find out why Hamilton ETFs calls themselves financial experts, right? It says that right under your logo. Most of your ETFs are just on financials. The name of your company is named after Alexander Hamilton, a financial genius. So why does Hamilton ETFs consider themselves financials experts?
Yeah, so we're financial specialists. So first of all, thank you for having us back. We always enjoy these videos. So the financial sector is our home. So all of our partners have deep experience in the financial sector. Before founding Hamilton ETFs, I have 27 years of experience in the sector across multiple disciplines. My partners have specialized in the sector for at least another 30 plus years on top of my 27. If you go to our website, you can see that we write extensively about the sector. And the other thing we've done in the past is, if you go to our website, we have notes from the field. We've traveled globally to visit financial services firms. So this is what we do. This is our home, and this is the area that we specialize in and focus on.
Wow, perfect. I had no idea. Thanks for that. That's appreciate that. So, all right. So first question I have for you, in the simplest, most non-technical way possible, with the least amount of investing jargon, why do interest rates help financial stocks like banks, insurance companies, etc.?
Sure. So in its purest, simplest form, speaking only of banks borrow at low rates and they lend at higher rates, and they generate spread revenue. Mm-hmm. So if the yield curve, which is the difference between the central bank rate and the 10-year, which is how most people define the yield curve, if that spread widens or the yield curve shifts higher, that's generally very positive for financial stocks, banks in particular, because the spread revenue gets bigger. Maybe even a simpler way of putting it is, and this would be intuitive to most of the people who have bank accounts, is that when interest rates rise, banks increase their rates on loans faster than what they pay you as a depositor. There's also other areas too, which would be quite intuitive to your audience. For example, if interest rates rise or central bank rates rise, wealth management companies make money on margin balances, right? If rates go up, you pay more on if you borrow to invest.
Right.
And lastly, rising interest rates are usually coincident with improving GDP growth, which generally speaking is positive for the financials. So everything in moderation, but that would be the simplest explanation.
Yeah, that makes sense. I mean, it's kind of what I read on Investopedia and what I showed in the video earlier. So thanks for the explanation. Yeah. Now let's talk about how to take advantage of this as an investor, right? So we know that you guys are financials experts, and we know that one of your most popular ETFs, HCAL, is Canada's top performing ETF in terms of total return for 2021, which has the 6 Canadian banks, right? The top 6 Canadian banks ETF, I should have pointed out. So it seems like you guys really figured out a great, or the best magical formula to get the most overall return from the 6 Canadian banks. HCAL beats, or the performance of HCAL, beats holding the 6 banks individually. If you just invest in them on their own, it beats an ETF where it simply has the 6 banks on an equal weighted basis, like ZEB from BMO. It also beats a covered call bank ETF like ZWB, which isn't really surprising because covered call strategies tend to sacrifice a little bit of total return for more income. So the magic formula seems to be diversification combined with that 25% leverage. So how did you guys come up with that formula? And you think it will continue to outperform all other big six Canadian banks strategies out there?
Yeah, and so just for clarification, HCAL was the top performing Canadian bank ETF.
Canadian banks ETF,
but yeah,
correct.
So a few things. First of all, adding a little bit of leverage, and again, emphasizing the word modest, does add to the yield and the total return. And the one thing we like to point out is, if you believe the sector is going to rise over time, and we do, and historically it obviously has, the power of compounding of just even a little bit of modest leverage can be highly material after, say, a 3, 4, 5-year period. In fact, HCAL has outperformed ZEB by well over 10%. It was only launched in October of 2020. It's like 25% plus ahead of ZWB. This is what I'm talking about when I say the power of compounding. But I think when we talk about diversification, and I think I may have mentioned this in maybe a prior video, but basically what happens is if you compare, say, HCAL to an individual Canadian bank, for example, by putting together the portfolio of Canadian banks, you get a benefit in terms of lower volatility from diversification. So you just have more names, they tend to cancel each other out, or some of the volatility gets smoothed out. So you get a lower volatility from diversification. And then I guess for lack of a better phrase, we spend a bit of that benefit in the form of modest leverage. So the volatility comes down from diversification, and then we bring it sort of back up to the average in the form of a little bit of leverage, 25%. So believe it or not, HCAL has a similar volatility profile to an individual Canadian bank. So even though it has quote unquote leverage, it's not meaningfully different in volatility and risk to just an individual Canadian bank. So bottom line is, if you believe the sector, the Canadian banks will rise over the long term, then this is a very attractive structure because you get higher monthly distributions in the meantime and higher total return. And the longer your time horizon is, the more benefit you get from compounding from that. So we actually really, really like this product. It has been very, very popular. It's approaching 400 million of AUM, even though it was only launched in October of 2020. And quite frankly, we think it's the best Canadian bank ETF.
Yeah, I mean, the numbers speak for themselves. And I like how you say, it has holding HCAL, even with that 25% leverage. So there's a big stigma out there that anything leverage is inherently more risky. So what you're mentioning, correct me if I'm wrong, is that HCAL is actually, even with that modest 25% leverage, is less volatile or less risky than owning, for example, just Bank of Nova Scotia on its own, right? Do I have that right?
Similar. It would be very, very similar. So,
okay, it would be similar, even with
that.
Yeah,
it's not definitely not lower, but it's about the same. And the modest leverage is on a low beta underlying, right? The Canadian banks are not a volatile sector,
right?
So you have a standard deviation of X, and then that number is quite low compared to, say, gold or mining and energy and all kinds of other things. So you have a low beta underlying, you add a little bit of leverage on an already low beta underlying, and it doesn't have the same impact as say you added it to gold, for example.
Yeah. Yeah, for sure. I mentioned this actually earlier in the video. If you're going to use leverage on something, the best place to use it on is really quality stocks. And Canadian banks, I mean, the 6 Canadian banks, that they have no equal. They're much safer and less volatile than the US banks, for example. I'm sure they have lower beta than them, or
they do.
It's I'm very my whole channel is really about buy and hold long term investing. So if you're going to hold something long term, make sure it's quality, and that's what you could put some modest leverage on, right? Right. That makes sense. And I got this. We talked about this in an earlier video. I'm going to ask you this question again. You already answered it, but HCAL does use leverage, which means it borrows money at a certain rate to buy more units of the 6 banks. So interest rates are rising. I've gotten the questions from a few audience members. I know you answered it already, but I'll ask you again. How does increasing rates impact the leverage of HCAL? Is it a big deal?
Yeah. So there's 2 important variables to think about in answering that question. The first is the amount of leverage is very modest at only 25%. The second thing is we borrow at very low institutional rates, and those rates indeed are fractional to a retail margin account. So let's use a simple mathematical example. So if the central bank rate, Bank of Canada rate, goes up 25 basis points, then basically 25 basis points times 25% is 6.2 basis points, I think, give or take. And that's the increase in the cost of borrow on an annualized basis. So if rates go up 100 basis points, then the cost of borrowing for HCAL and HFIN and our other modestly levered products goes up by 25 basis points. And that's in the amount annualized over the course of a year. So we don't, I mean, we think that's a pretty low number. And so we think people can feel very comfortable that if interest rates were to rise, that's the quantum and that's the rule of thumb on how to figure out what the cost would be.
Yeah, it's peanuts, basically. I know you probably won't use that term.
No.
But it's very, very, very small. And like you said, it's modest leverage, number one. It's only 25%. It's not much. Plus, you guys pay much cheaper than if I would take margin in my Questrade account and borrow money to buy more shares of the Canadian banks individually. Yeah, you guys are an institution, right? So
and what you get for that is, to the extent the sector rises over time and your returns are 25% higher than what they would have been otherwise, this is what you paid for, but that's what you got. And as we've seen up to this point anyways, that's been a very worthwhile trade-off.
Yeah, the trade-off is always going to be worthwhile, especially with these 6 banks. They have growing dividends. The dividends more than cover that, I'm sure. So thanks for re-explaining it anyway.
Yeah, I mean, the only time it's negative, obviously, is if the sector is going to fall and stay down for a very long period of time. As long as you believe the Canadian banks and the Canadian financials and the S&P 500 and TSX 60 for H-yield and HDIV, for example, as long as you think they're going to go up over time, and this is why we always emphasize long-term investors, then we think this is a very attractive product and a very responsible and sensible structure.
Yeah, and rising rates, like we mentioned, actually helps the banks anyways, right?
Yeah,
so that's another thing to consider. Okay, perfect.
As long as rates don't go up dramatically in a short period of time. So rising rates are good. I should give a caveat. There's no question that rising rates, a steeper yield curve, one shifting higher, is positive for the financials. Where it becomes difficult is if rate increases are so fast and so high that they disrupt GDP growth and cause a recession. That doesn't look like it's going to be the case here, although valuations are quite low, but that is the caveat. But again, long-term investors throughout a full cycle, you should benefit from the structure.
And what you just described is basically the entire mission and problem of the Fed that the Fed has on a day-to-day. That's all they're looking at is how much do we do without disrupting. That's all they talk about, right? When you see them, basically in a nutshell, that's their entire job or mission. So
Bank of Canada as well, absolutely.
The Fed in the U.S. in Canada, it's Bank of Canada.
All of them,
central bank. Yeah. So all right, so we covered HCAL, but a few months ago, you guys released a new ETF called HFIN. Very similar to HCAL, but a little bit more broad in scope, right? So instead of just the big banks, the big 6 Canadian banks, it also has the top life insurers in Canada, as well as some top asset managers like Power Corporation of Canada, Brookfield. So why would an investor choose HFIN over other diversified Canadian financials ETFs out there? There's many of them out there. Some popular ones are FIE or XFN, for example, from iShares, BlackRock.
I mean, so again, this is the same principles for HFIN as it is for HCAL versus ZEB and ZWB. So relative to XFN, I mean, we would prefer HFIN for the same reasons we prefer HCAL over ZEB, ZWB, which is it has higher long-term growth potential and it also has a higher dividend yield. But, we'd also point out XFN is market cap weighted. So it's, which means, in a period where perhaps one individual large bank is struggling, it might have a bigger impact. So this is equal weight. So it's not quite as focused on some of the individual names. Also, XFN has some exposure to some maybe not as good financials because they own everything on a market cap weighted basis, whereas we were able to just pick the top 12. That 12 is in very good shape. And so, but at the end of the day, again, same idea, a little bit of leverage, not much, get a higher dividend yield while you wait. And again, if you're going to own over the whole cycle, over time, this should benefit. In terms of FIE, this is kind of an interesting, this one doesn't really come across our radar screen, but it's actually quite a large fund, but it's 30% fixed income and preferred shares.
Right, there's bonds in there, yeah.
Yeah, so over time, because the financials have risen over time, this ETF is underperformed by quite a bit relative to, all equities. It does have a modestly higher yield, but if you believe the sector will rise, the opportunity cost of underperformance would be material. Also, it's not clear what the impact of rising rates would be on the 30% allocation they have on prefs and fixed income. So, rising rates, are generally speaking negative for fixed income instruments.
Yeah, and it's not leveraged either. And typically, I personally don't really like fixed income that much. It's kind of yucky for
Yeah.
me. But yeah, perfect. Thanks for that. So that's all the questions I had about interest rates and HCAL and HFIN. I do have two quick questions from audience members that I got. So
Yeah.
whenever I know you're coming, I said, Rob's coming. Do you have any
Sure.
questions? So this one is from Louisa. Are there any inherent risks to stock prices? Dividends? Can they forecast a bottom? And I'm assuming she's referring to rising interest rates here.
Yeah. So let's deal with the two things separately. I mean, I don't
Mm-hmm.
think there's any question that there's always risk in the stock market. If something terrible were to happen, some sort of big macro event, everything, equities would fall, Canadian banks and financials included. There's no question about that, and there's no getting around it. Having said that, as it sits today, financial stocks are very, very inexpensive. There's no question in the last, call it 2 months, give or take, the market has significantly increased the risk of a recession. The Canadian banks trade at just 10 times current earnings and 9 times forward earnings for the benefit of the audience. Those are effectively trough valuations given we are not in a recession at the moment. HFIN and HCAL have yields of 6.2%. The Canadian banks have an exceptional record of maintaining and growing dividends, with one exception. The insurance companies have also done very well. But as they sit today, there's no reason to believe the insurance companies can't sustain and grow their dividends. So, and this is a very tax efficient structure, and the yields of HCAL and HFIN are over 6%. So you have low valuations, a higher yield. By the way, the Canadian banks report next week, and we expect that it will be actually quite a good quarter. Would not surprise us if everybody beats. It also would not surprise us if dividends were increased in the high single digits.
Perfect. Well, I didn't know that. I didn't know the banks have such low PE ratios.
Yeah.
That's like half of tech companies or something like that, right? I mean, tech companies are like
Yeah.
20 or 25 or something like that.
Yeah. Financials are definitely traded at lower multiples for sure.
Okay, well, that's great information. Thanks for that, Rob. Next question, last one from Diane. This is more of a broader question with what's going on in Ukraine and the global sanctioning. Plus, we're moving into the post-COVID economy. Maybe not in China, but in North America, we are.
Right.
So this is more of a broad question. What do you think the impact is of all this crazy stuff going on?
Yeah.
Let's start with the
So
war first, maybe.
yeah, I mean, no impact really on direct impact, anyways, on the Canadian financials. I mean, at the end of the day, all of these macro events, whether it's what's going on in COVID, whether it's China, whether it's Russia and Ukraine, really at the end of the day, what you're asking yourself is, does this event have an impact on global growth? Because obviously the Canadian banks don't have loans in Ukraine. So is this going to impact global growth? Yes or no? And if so, to what degree? Might it affect Canadian growth? Obviously, commodities might be influenced. And the second thing you're asking yourself is it going to have some, and if it does impact global growth and or inflation, is it going to have an impact on monetary policy? Or put differently, is it going to have an impact on the yield curve? As it sits today, there's no question. There's one outstanding, the elephant in the room is, as monetary policy starts to normalize and central banks start to raise rates, can they do so? Can they tame inflation in a way that they can engineer either a soft landing and or avoid a recession? And so, as I mentioned in the previous question, bank stocks trade at quite low multiples now, probably at least a multiple point below what their long-term average would be, which is a lot. And they're pricing in a non-trivial risk of a recession. They're going to get reporting next week. You're going to find out in 6 or 7 days on the banks anyways. And there's no reason to believe that you're going to see rising loan losses or any evidence of an economic slowdown. The sector has never made more money. It's never had more capital. It's for the most part almost never had more reserves. They're running at cyclically low loan losses. The sector is extremely healthy right now, very cheap, but at the same time, very cheap and paying high yields. The only way this kind of really goes sideways is if we go through an extended period of time where inflation is just so persistent that rates have to go up to a quantum and a velocity that disrupts GDP growth. A lot of prominent strategists and economists would suggest that is about a 1 in 3 chance. Nothing is risk-free, but right now the risk reward would seem to favor the financials.
Yeah, and what you just mentioned is great. I mean, this is why I invest the way I do. For me, the economy it's all about cycles. It's always moving and changing. This is why it's always best to be, in my opinion, of course, a long-term, really
Yeah.
long-term investor. Take advantage of the cheap prices of what's coming. And this is why, I tell my audience, I'm not scared. Even if a recession does come, fine, good. I'll take advantage of the
Mhm.
lower stock prices. I mean, it's if you're hold as long as you hold quality blue chip
Yeah.
stuff for the long term, you'll be okay. The stock market can't just keep going up forever. I know a lot of my newer members in the community, they're kind of, they get more worried, right? Because they started investing in like 2020, 2021, and it's been a fantastic year. And now all of a sudden things start going down, especially in the US side, because it's very tech
Mhm.
heavy. So a panic starts to set in. But what I tell everyone, just buy and hold long term. The stock market can't keep going up forever.
Mhm.
It can't keep going down forever either, right? The inverse
Yeah.
is true. So
But your
uh,
strategy of passive income is somewhat designed for this kind of market. So
that's why I developed it. I mean,
right.
my bread and butter
Oh,
is really the higher yielding covered call stuff, and that's
right.
what performs better typically in the during a flat market or a more volatile market. And you guys, I'm sure, know this because that's why you came out with HDiv and H yield, which is not the focus of this video, but we've done
Yeah.
other videos on which are
Mhm.
basically covered call focused
Yeah.
ETFs, which shine during this type of volatility.
Yeah,
So
and give you, yeah, and absolutely pay you to wait. And as
pay
long
you
as
to
you're a
wait.
long-term investor, as long as you're a long-term investor, and as you said, you're not emotional and you don't, and you've got a high quality underlying, which obviously the Canadian financials are, then you can wait it out. And in the instance of these two, I think the yield is roughly 6.2 for each,
Yeah.
and the valuations are low. This is a pretty good time. Or
Yeah.
assuming there's not going to be a deep severe recession, which it doesn't seem like the highest probability outcome, albeit it's important to acknowledge the risk is not zero.
Yeah. So to my audience, always remember to buy and hold, guys. And it's funny what you said, Rob, about don't be emotional. My wife sometimes tells me she thinks I'm a robot sometimes because
Right.
I'm not even. So I'm kind of like perfect example of the investor you want to be. Just keep your cool as long as you're getting paid every month. Everyone, you have
Mhm.
quality. You'll be in a good situation long term. That's the key. Buy and hold long term. So Rob,
Yeah.
again, thanks for coming on. You're a good
No,
friend of the channel. Hope to see you again soon. And
absolutely.
thanks again.
No, and thank you for having us. We appreciate it.
Take care.
Okay.
Thank you so much for watching, guys. I really appreciate it. Please show your appreciation by hitting that like button. It helps the channel grow. It's free for you. It's a win-win. It takes 2 seconds. I would really appreciate it. Also, consider subscribing if you like this type of content. My channel is all about investing for maximum passive income. So please subscribe. Hit that little bell button as well so you're notified whenever a new video comes out. You don't want to miss my upcoming content. And of course, make sure to visit our website, passiveincomeinvesting.ca. That's where you could purchase and sign up for my digital product, the ultimate DIY investing package, which is on version 3 right now. So I'm very proud of this product. I'm very proud of this package. It comes with lifetime updates, so you only have to buy it once. And when you do, you will have all the next updates for free. And I do plan on making version 4, coming out with version 4 in Q3 of 2020. Too. So that package will help you invest on your own. Basically, it has lists of funds, ETFs, closed-end funds, split funds, as well as a lot of sample portfolios. I have sample portfolios for Canadians and Americans, and tailored to different investing needs, not just income like I do, but also growth, also dividend. There's low risk income, aggressive income. So it's a very, very cool product to really help you build your own portfolio. That's really what it's designed for. So make sure to pick it up if you haven't already purchased it. And of course, there's also a bunch of free tools and resources on my website at the top right, free tools and resources. And right there on the homepage, I do offer a one-on-one consultation service with yours truly. So if ever you want really more personalized help, you could book a one-on-one with me. We'll have a 1 hour Zoom call. I'll go over your existing portfolio. I'll help you transition to an income portfolio. I'll answer all your questions, whatever your needs are. I really love helping people out, and my appointments do sell out very, very quickly. I apologize. I can't do more than 4 a week because I need time to do the content, to publish more content, of course. So just look at the little message on top of the calendar right there on the homepage to get a status of the appointments. Usually I will open up the appointments for the next month on the 25th of each month. So stay tuned for that. And also, if you want to join our community, we have a Facebook group with over 10,000 members now. Passive Income Investing, that's the name of the Facebook group. So if you like this sort of content, I strongly suggest you join the Facebook group. We monitor it very closely for spam, so it's very, very clean, and everyone shares their ideas and shows their portfolio and the income they're making every month. It's very, very exciting that the community is growing. So make sure to join us on Facebook. We're also on Instagram. So Instagram, make sure to follow us if you want a little bit more personal content on our life, including our move to Panama. So if you want a little bit more personalized content to us, you could always follow us on Instagram. So the mission of this channel, my mission, will never change. It will always be the same, everyone. It's to help everyday, normal, regular people invest on their own, to do it yourself investing, so they could build their own stream of passive income and enhance their quality of life and eventually become financially free, financially independent like us. So with that, take care, guys. Make sure to stay healthy, stay safe, and of course, stay passive. See you next time.